right. So, good afternoon and good morning, gentlemen. Thank you for having. Thank you for being here. Wanted to, and also thank you everyone else for joining our second AMA Goldfinch. So I want to just set some, share some opening remarks before we dive just straight into it. But overall, just once again, thanks again for joining. Essentially today, we're doing an AMA to learn more about the Cauris team in the context of their first of hopefully many pools that we'll be launching on the Goldfinch platform. As context and to let everyone know just, about myself, my name is Sam. I'm the Chief Investment Officer here at Goldfinch. And with regards to the format of this conversation, just before we dive into it, I want to let everyone know it's going to be a three-part conversation, with the first part being the Cauris team. You can see all that we're on right now will introduce themselves and share more about what they're building. Second part will be they'll be diving into their deep dive platform, which they'll tell you more about on the back of that. And then finally, we'll be wrapping up with community Q&A. So we've got a bunch of questions that have already come in. So please, whether it is through YouTube Live or a Telegram group, please just start dropping questions in and we'll be feeding them into the team as we keep going through. But with that, just want to say thanks again to the whole Cauris team. And we'll turn it over to you all so you can just walk us through, all the great things you're building.
Awesome. Thank you, Sam, and thank you, Bina, for having us on the Goldfinch channel to talk about our upcoming pool. So my name is Azer Songnaba. I am the Chief Investment Officer of Cauris. I lead the investment function from structuring, pricing, and risk management of our deals and of a pool that we are bringing to you. Prior to co-founding Cauris, I was recently with MasterCard leading the analytics and insights function for the cyber and security division. I also worked in risk management at MasterCard, where I underwrote and risk managed a portfolio of customers, including financial institutions and fintechs. Prior to MasterCard, I worked at Goldman Sachs in the structured finance division within the investment banking, where I originated, structured, and distributed over $10 billion of structured transactions in the auto and equipment leasing sector. So in short, I think I bring in an experience in measuring and managing risk, while at the same time structuring transactions that make sense for our customer and also for investor. On the personal side, I was born and raised in Burkina Faso, a small country in West Africa, and where I basically have seen firsthand all the issues that Cauris is set out to solve. And I'm really glad to be part of this journey and to be partnering with Goldfinch to make and the Cauris team to make this happen. So I'll turn it over to Charles and Ramesh to also introduce themselves.
Thank you. Thank you, Azer. Hello, everyone. Thank you for having us today. So this is Charles Packer. I'm the Chief Information Officer at Juvo. So I have over 20 years of software engineering experience, most recently in the fintech space at Juvo, where I worked with Alex, who's our CEO, and I was the director of both our data and application engineering teams. So at Juvo, I oversaw our data ingestion, analytics, and loan decisioning integrations, where our platform processed millions of transactions per day while building financial identities for the underbanked. And at Cauris, what we're doing is I'm bringing that experience in fintech engineering to DeFi, building products and systems that bridge the gaps between those two domains. Personal note, I'm born and raised in the Bay Area, living on the peninsula. Over to you, Ramesh.
Hey, thank you, Charles. It's a pleasure to be here with everybody on the Goldfinch platform. My name is Ramesh Dhanaraj. I'm a special advisor to Cauris. Most recently, I came from Fortress Investment Group in New York, where I was a senior investment manager in their special situations private credit investment group. Prior to Fortress, I was a financial services and credit lawyer with Sidley Austin and Blank Rome, and actually started my career as a early stage venture capital and growth stage equity investor. It's a pleasure to be here. On a personal note, I was born in Singapore, spent much of my youth in Southeast Asia, so issues of financial inclusion are particularly close to me, and therefore very interested and excited to be part of the Cauris platform.
Awesome.
With that, I'll turn it back to Azza.
Yeah, and thank you. And the other team member who is not here is Alex Liege, our CEO. Unfortunately, Alex had he's babysitting right now, so he has his other job, which is basically he has like his son, his daughter that home with him today. So he's listening to us, but won't be presenting. But Alex brings in decades of experience in fintech, having worked at MTN Money in West Africa, and at MasterCard, and lastly at Juvo, where he was head of products. Alex was also born in Africa. He was born in Togo, but he's a French citizen, and he lives in the Bay Area. All right, so that's the team that will be presenting today. Now I will move on to basically kind of giving you an overview of why Cauris, what we do, and why we do it. So Cauris has the mission to provide access to capital to 100 people across the globe. In emerging markets, and as Ramesh or Alex will know, access to financial services is not mainstream like it is in developed countries or in developed markets. Even though banks have been in those parts of the world for decades, but the penetration and having a lot of people participate in the financial services hasn't really picked up as anyone would have loved. So to close the gap on financial inclusion, we believe that fintechs, and we actually are really sure that fintechs have a great role to play, and that Cauris, right, can leverage the power of DeFi to provide financing to those fintechs to then serve underbanked or customers that don't have access to financial services and to financial product. So what we do as Cauris is to provide financing to those fintechs to enable them to serve their customer that are otherwise excluded financially. And we power that through the power of DeFi, and partnering with a platform like Goldfinch, we're able to really provide financing that is both affordable and also makes sense to those types of entities and help them serve customers. So a lot of people always ask us, so can I come to you and borrow money because I'm financially excluded? And we always have to kind of explain exactly what our business model is, and basically how do we go out to customer? What do we mean by customer? So here we actually have like an example that actually brings that to life. On the left-hand side in this page, right, you have Adia Shapur, who's a student in India. She needs financing for a short-term emergency, for instance, and needs access to $10. She cannot go to the bank because banks actually are not going to be giving money to for small amounts like that, and for someone who probably doesn't have like a very strong, robust credit history, right? So then we have like fintechs that are actually coming in that segment and basically providing short-term unsecured loans to consumers like Adia, for instance. And we work with those fintechs. So we can have the example of Branch, for example, which is one borrower that's on our pool. You have other companies like PayJoy, Lipa Later that kind of operate in that segment of the market. Another use case that we're also solving for are gig workers, or gig worker economy. So for example, you have Albert Dupont here, who does food delivery in Paris, and he needs a motorcycle to be able to do that, but he doesn't have the means to actually secure a motorcycle. So you have companies like Gozem, Aria, Covey, who are basically providing financing to gig workers and allowing them to actually get the equipment that they need in order to provide services. And for that, we basically have a company like we're providing financing to those companies to be able to operate. And on the third use case that we also deal with are small enterprises in emerging market. So for example, here we have the example of Adina Ose, who sells groceries in Accra, Ghana. She needs financing to be able to finance her merchandise and basically be able to operate. And in that case, you have companies like Precessia, you have Float, you have Monkey, who basically provide financing to small and medium enterprises to be able to operate and have access to the capital that they need to serve the economies, basically. Moving on, we're going to talk about basically what do we do as Cauris. What does a Cauris loans look like, and who actually can get a Cauris loan? So as I mentioned, we work with different segments in the ecosystem of financing. But we have a geographic focus on Global South and Europe. In Global South, you can have many definitions about it, but what we really mean by that is that we're looking at countries within Asia, Latin America, and Africa. And we also have like use cases in Europe, where, especially on the gig worker side, there's very solid opportunities there as well. Our customers have a well-performing loan book or payment flows that they can actually use as collateral. So basically, we are not giving loans that are insecure to the fintechs, but we are actually for securing that against assets. And those assets can be the loan books or any other asset that we might deem valuable in securing and making sure that we get repaid. Those fintechs also, as I mentioned before in the previous page, provide financing to consumer, gig worker, or small and micro enterprises. And those financing tend to be very short term, basically less than 1 year. But on average, we've seen most of our clients have like loans to the customer around like 90 days or sometimes even lower than that, shorter than that. And they generally need financing between $500,000 and $20 million. And basically, we're giving them financing to finance their operation in terms of lending to customer. We don't finance general corporate purposes, but just we provide money to be able to allow them to finance the receivables and provide financing to end customers. So next, we're going to talk about our investment management process, but in a high level, and I think Ramesh will take us deeper into our process. But we are basically, we have an underwriting process, right? That basically kind of looks into both on-chain and off-chain. And off-chain, what that really results to is a credit agreement that we sign with the fintechs that we want to lend money to. So we look at their books, look at their history, their performance, and we do our due diligence from a legal side and from an operational side. And then we sign a credit agreement that is binding, meaning that they owe us money and we have recourses on how we can actually collect in case there's an event of default, right? So that's basically what happens off-chain. On-chain basically embeds the structural protection, leveraging the smart contract technology, the NFTs that investors in our Goldfinch protocol will actually end up owning, right? And one structural protection that we have there is basically like a sequential payment waterfall. Basically, the senior pool gets paid first, and then the junior pool, and so on and so forth, right? So basically, we're leveraging the technology on chain to basically make that happen. One thing that we really pride ourselves about on is our ability to actually bring both worlds together, basically the on-chain and the off-chain world, through a proprietary system that we have put together that basically allows us to monitor the portfolio of those fintechs and kind of also cover the covenants, compliance, certificates, and all of that into a proprietary system that we call Deep Dive. And Charles is actually going to walk you through what Deep Dive does and kind of give you an overview. It's very neat and basically kind of gives investor a good sense of basically what's going on the pools that we have financed. So with that, I'll turn it over to Ramesh to kind of walk us through into details into the underwriting process and the feature of our pools.
Great, thank you, Azar. So we conduct a very robust underwriting process that starts all the way from the beginning of meeting the management team and evaluating the quality of our introduction, the experience of the management team, the review of the operations of the company, and also your traditional business due diligence on how the companies run. Because these are ultimately asset-based loans, we take a very close look at the underlying loan portfolios. This means performance, default rates over time, and ultimately the credit quality of the end borrower that our fintech borrowers are ultimately lending to. So it's a very robust performance analysis. And then on top of that, we look at the legal structure in which we actually transact. So we exclusively do senior secured term loans. We're the most senior lender in the capital stack, and we make sure that we have sufficient collateral. We're well over collateralized in the loans that we make, and we also require that there is an equity cushion, that there's substantial protection from the equity providers, so that we are not the first loss in any adverse event in our portfolio. So it's really a combination of a very strong business underwriting method, as well as providing all of the legal protections that are available to us. And this includes an analysis of each of the secured and lien structures in the various countries that we deal with. So we employ top law firms in each jurisdiction, and we make sure that we have a good understanding of enforcement in all of the various jurisdictions in which we transact. And typically here we start out with the term sheet, with the traditional key parameters of our investment, and work towards a full security package, including the credit agreements, which have very specific covenants that cover the kind of quality of the portfolio as the loan book progresses.
Okay.
Azar, I think we can go to the next slide. So here we mentioned some of the structural protections that we have provided. Starting here at the top, there's a sequential waterfall in payments, both at the level of the company that we're investing in, as well as from your perspective as an investor. So you are the payment back to the Goldfinch investor is the most senior payment in the waterfall. As we move around here on the circle, we again take a full security interest in all the assets or key assets of the borrowers. That's an actual statutory lien, as well as what we call tripartite deposit account control agreements, where we have control of, or seek to have control over the bank accounts and the receivables of any fintech that we're lending to, so that we can immediately exercise our control in any kind of default situation, or even prior to a default situation. We have a dynamic advance rate, which what that means is we look at the quality of the loan book over time. And if the loan book were to experience higher defaults, we immediately change the advance rate. That's the rate at which we borrow against the receivables over time, looking at how the general portfolio is kind of building. I mentioned the account control. Here, cash is really the important, cash and receivables are really the most important asset and collateral in the lenders that we lend to. So we look at that very closely. We are seeking a diversified pool of assets, both respective types of investments, as well as, or types of companies that we invest in, as well as geographically. And then finally, we have skin in the game, meaning the Cauris is actually investing itself through its own venture fund. So we're completely aligned with anybody who's investing through the Goldfinch platform. I think we can go to the next slide, Azar.
Okay, thank you. Yeah, so thank you so much, Ramesh. And so now we're gonna jump to deep dive, and Charles is gonna walk us through a demo.
All right, great. right. One moment. All right. Okay, can you see my screen?
Yes.
Excellent. Okay, so Deep Dive is a project we're developing to provide insights into the underlying health of tokenized real assets. So what you see here is sample data we put together to demonstrate how we structure the deals, how we structure our pools, and the visualizations that represent those pools. So what you're looking at here is a sample pool with 8 fintechs across 6 countries and 3 currencies. So we have 2 sections. We have pool analysis and we have partner analysis. So first we'll look at the pool analysis. At the top here, we have a map view where we show the represented countries that are in the pool with a description of the pool. Next, we have a breakdown of the allocation by asset originator, country, and currency. We want to demonstrate here is like the diversity and balance within our pools. So that we can show how we balance the assets within the pools. We have concentration limits that demonstrate how much we want each representative asset to exist. So for example, you see Smart Card here at 23%. They're below the concentration limit, so they're in green. That's great. India is at 23%. And then for currency, we have non-USD and Euro. We have an exception for USD and Euro where we allow for a greater representation in the pool. Next, we scroll down to disbursement history. We want to show how the pool has grown over time. So these are the different fintechs in our pool and how they've grown. So the second section we want to demonstrate here is the portfolio analysis. So each partner is represented here in this list. You can click on them to expand, and you have 3 tabs here. So each tab represents a different category of analysis. First being portfolio characteristics, where you have a snapshot of where they are today and historical analysis as you scroll down. Next, we'll look at portfolio performance. So this is essentially for consumer lending, this is delinquency rates and write-offs. So you have transparency into the performance of the assets, how the overall health, and how the money that has been dispersed to them is performing. And lastly, we have covenant compliance, an essential part of what we do. So in our contracts, we establish covenants. We want to make sure that the borrower is meeting those covenants, and we have a demonstration here of sample data of where a partner might lie against our covenants. I'll scroll down so you can see the 4 different covenants we've laid out here.
Awesome. Yeah, and then just one thing to mention, right? So the covenants are we have like standard covenant that we usually have for most our borrowers. So for example, the advance rate, we do have the interest, the cash interest cover, and the tangible net worth, right? But depending on the customer, those might actually change. Those covenants might change, right? So for any customer that we have on our pool, we might have like a different set of covenants that are basically going to be dynamically included here. And anyone investing in the pool can actually see basically how this pool is performing overall and how any additional fintech in the pool is performing. And I think there's another question that a lot of people keep asking is like, how do I know which company we lend to, right? So with using Deep Dive, you can come in and see exactly what is the disbursement history on any given fintech that we have on our vehicle.
Perfect, thank you. So yeah, we saw this as an opportunity. We see Deep Dive as an opportunity to provide the transparency. So when you look at pools, you have an understanding of the quality of the assets and how they're performing.
And I would just add, this provides a really important asset management tool for us, because rather than to be reactive and wait for an event of default, we can see trends over time, and we can step in and help to manage or intervene before situations get into a default scenario. So this allows us to react very quickly, given the robustness of the data.
Perfect, thank you. I'll hand it back to you, Claire.
Thank you so much, Charles, for this demo. So that's all we had prepared our opening remark and a quick presentation on what Cauris is and what Cauris we're really excited to be bringing this opportunity to the Goldfinch community, and we are looking forward to collaborating with you on this transaction and on many more to come. So Sam,
Okay,
back to you.
perfect. Okay, that sounds perfect. So definitely thank everyone for that. And I think this dovetails really nicely into a lot of the questions that we're seeing come through and that we have already. I also personally have. So really just diving into it. First question I really ask is, I know basically, as Ramesh, you mentioned this before, but basically, can you just describe what protections there are in your vehicle, basically in terms of why the various investors should feel safe?
Okay, sure. Yeah, I can take that. So the protection available in the vehicle, I think, can come from both an individual fintech at an individual fintech level and at a pool level. So let's start with the individual fintech level. So as Ramesh mentioned, we've thoroughly underwrite every single deal in the pool, looking at management performance and background, to operation, to how they disperse and collect information. So once we have that, we are really confident that these fintechs know what they're doing and then that they can execute. Then we look into basically our document, how we actually structure that. So our document, our credit agreement have a borrowing base and an advance rate. And basically that actually gives us a cushion in terms of losses. So basically our advance rate usually goes between 70 to 80%, which means that any given fintech can have losses depending on if you get it 70 or 80%, you can have losses up to 20% in your loan book before you're not able to make a payment on that obligation to us, right? So that's that's a good equity and cushion that we have embedded in our pool. Also with deep dive, we have basically, we monitor exactly how those losses are going. As we see losses going up, we can just tell them, okay, stop. Now we just want to kind of take control. Basically it becomes an event of default, and we can step in and basically kind of ask for repayment. So those are protections that are there for at a fintech, individual fintech level, to make sure there's no default. Now at the pool level, we are benefiting from the effect of diversification. There's going to be many fintechs in our pool. So as you have many vehicles, many investment in the pool, some can default and some can perform, and the entire pool is going to be okay. So there's that. Also, we have the sequential waterfall. So depending on where you go into this pool, if you are the junior backer or the senior pool, there's basically cushion from that stance, right? So the senior pool will have to have all of the losses to actually pile up in such a way that all the junior pool gets impaired before there's a loss into the senior pool. So that also adds additional protection into the vehicle. But overall, we really believe that the power of securitization comes in for having quality assets. The underlying quality asset has to be there. And that's what we are really spending a lot of time with the expertise that we have doing this at major banks and investment firms, that we're bringing that to Cauris here. We're able to really bring in very good quality assets, and that we can service in such a way to prevent any losses. And I don't know if Ramesh or anyone wants to add anything to that.
I think you covered it really well, Azar. I think I would just add, and we can get more into this later, is there are protections that we've purposely built into your agreement in investing that also cover you from a structural point of view, and I can talk more about that I think as we go on. Okay,
perfect. And I mean, Azar, you actually basically already touched on, and what would have been the second point around pool diversification. So I'll just skip over that and really just actually dive into thinking about recourse. So just broadly speaking, like, what recourse basically do investors have in terms of investing in this pool in the context of their protections with regards to participating?
Absolutely. I'll be happy to take that. We very specifically designed our operating agreements and our offering agreements with the Goldfinch investors such that there are recourse for defaults that Cauris may have in the pool itself. So most importantly, there's a payment obligation that your contractual interest payment is made. Then there are also other obligations that we are only investing in the types of companies that we have contracted to invest in. So emerging market fintech companies. We don't invest in anything outside of that. And we also have certain covenants in all of our agreements that we've already talked about. So there are a number of contractual covenants that are in our agreements with the investor pool, and that if we were ever to default on those agreements, the investor pool has recourse. One of those recourse items is default interest. The interest, there's a penalty interest that will apply should we become in default and unable to cure within a certain period of time. Beyond the default interest, there is also a point in time where the investors can vote to, a voting mechanism exists, so the investors can choose to replace Cauris as the investment manager and servicer of the assets if such an adverse situation were to occur. So those items are specifically built into the operating agreements and the execution documents that you'll see. And I think that provides a robust framework such that we can't have style drift. We have to invest in what our expertise is. And there are definite teeth to the covenants that we've provided in the case that we were to not be able to deliver on those covenants. Sam, I'll leave it back to you.
All right, got it. So then flipping then to the other side of the covenants and protections that basically the community investors would have, why don't we flip it over to essentially, like, how do you plan on using the capital, and where do you plan on putting it?
Yep. So the capital, as we mentioned, will be used to basically finance fintech. So we lined up fintechs for which we are going to be disbursing money as soon as we have it raised. And those fintechs we have them in the data room. It's there, but like, so since this is a public forum, I won't go into details, but like, we have identified those fintechs for which we want to disburse. We did our due diligence on them. We signed credit agreements that are in place, and basically once we raise the funding, the money will be going out to those fintechs immediately. So again, we are financing the loan portfolios of fintechs and not general corporate purposes. So any fintech cannot use the money to build a headquarters or an office or anything, but they only get this money in order to lend to the end borrowers, and those loans to those borrowers become part of our collateral package, along with other assets that the fintech might have, including the equity in their business.
Okay, perfect. And actually now, in terms of on the back of who you're investing in and the covenants that you have and protections, like, let's think about, like, well, basically what are generally the target or the returns. It's a general question, is like, just to really clear this up, everyone's like, how are you able to offer essentially like 18% returns for the junior lenders? And I would imagine that this could be a question you can just answer more generally in the context of like what back leverage actually is.
Absolutely. So I'm happy to take that. And so we are basically raising the financing from Goldfinch at 12.5%. That basically has to go into that has to basically support two tranches of how do you call it? Two tranches of debt, the senior pool and the junior pool. Now, the junior pool represents about 0.25% of the entire structure. So basically, the junior pool is offering the senior pool is offering leverage to the junior pool in terms of basically how the economics will work, right? And as a result, the senior pool economics are actually like lower than the 12.5% all blended rate. And we are basically using that delta in terms of the lending rate and the 12.5 that we are paying. And that's how we're able to boost the return of the junior above even our lending rate. So basically, if 12.5 comes in, based on the leverage ratio, a small portion of that goes into the senior pool. And then there's the benefit of leverage that goes into the junior pool that kind of get in a more robust interest return and booster in the return.
Okay, got it. So really, to sum it up, whilst you're paying a 12.5% coupon, the trade-off is people who decide to be in the senior pool get a relatively safer bet with a lower return versus people in the junior pool get a relatively riskier bet and are getting a higher return on the back of that.
Absolutely, you summed it up really perfectly.
Okay, so then thinking more broadly in terms of like your ecosystem and the growth and whatnot, from your perspective is, how do you actually just generally source your clients?
Okay, no, great. So the way we source clients, there's many sources. But one thing that also I think I forgot to mention that was the fact that we generally work with clients that have some equity backing, right? So basically, they're backed by strong venture capital firm that basically believe in themselves, believes in the fintechs, and have actually done some preliminary due diligence. So basically, we're coming on top of that, on top of those investors. So we do get a lot of inbound requests from venture capital funds, right? Venture capital funds saying, okay, we have portfolio companies that we really believe in. We are putting significant equity in it, but they need financing to grow. That's how we are basically sourcing some of our deals. We also source other deals from our networks in those markets. So we work with advisory firms in Africa and in Asia that basically have portfolios of clients that are basically doing that basically kind of fit in our investment profile, and they are basically kind of sending those to us in terms of just trying to look at them. Also references from other from platforms. From DeFi platforms like Goldfinch. I think you guys have made introduction to some fintechs that are looking for financing. We'll basically kind of take a look at them, do our due diligence, and if it works out, we are able to extend it. So basically, there's a lot of places where we actually source clients, and we have a very, very healthy and very attractive pipelines of fintechs that we are looking to onboard, that we'll be providing financing to shortly.
Okay, perfect. And actually thinking about this more generally, coming back to the security questions, like when you actually think about this in the context of the underlying clients/partners of yours, how do you actually enforce on the defaults that you have in your agreements with them?
Sure, I can take that. I think, first of all, we try to prevent a situation where you get into default or we're surprised by default. And we do that by taking a very active approach to asset management. So it's deep dive. It's not just looking at results quarterly, it's looking at results monthly and even weekly conversations with the management teams. So we should aim to never be surprised by a default situation and hope to be able to avoid those situations even before they come. When they do occur, our first step is to have an active dialogue with the management to understand what is the true nature of the default. Is it an underlying problem with the business model, or is it something more of an execution type issue or a timing issue, or somebody failed to deliver a report one day late or something like that, where we can work through processes and logistics to avoid those types of default. If the default, so we try to work with the management team in preventing those defaults and finding a solution to the issue. With that said, we do have very strong structural protections with respect to enforcing security on our collateral. So the first step would be to stop any future disbursements of the commitment to the company, and then look at what a workout situation would be, such that we can enforce our rights on the collateral, perhaps have to liquidate on that collateral and recover our full value on our on our loan. And one of the ways we do that is in each jurisdiction, we have attorneys who are specialized in the security regulations in those countries. So we know when we have to execute, we know exactly how to execute on a lien, as well as relationships with the banks that are holding the cash of the fintechs, and that we can step into those shoes, ideally of the account holder, and preserve our collateral that way. So that's primarily it. It's trying to prevent it beforehand, but when it does occur, we have a plan on how to maximize our value.
Okay, perfect. So there, yeah, you basically summed up how you are thinking about just managing post-investment risk. And then on the back of that, how you actually think about generally how you actually enforce if something were to go wrong, and some of the the steps that you take there. And seeing some extra questions, actually, some more questions come in. I do have one final question, just actually related more so to Goldfinch, but I'll skip over that for now. And so a question came in essentially around the, will there be more pools coming in the future? And I think the answer is yes, because you had mentioned that early on. But the second part of that question is like, what would your views be on with regards to like, what are the advantages of joining this Cauris pool now?
Yeah, I can take that. So actually going back to the first question, will there be more Cauris pools in the future? Absolutely, yes. Our mission is to touch 100 million people. And for that, we need hundreds of, if not billions of dollars to make that happen. So, and we really hope that investors in listening want to be part of that journey. It's a safe journey. It's a very exciting journey, and we have a vehicle that can actually provide protection for any investor to achieve high risk-adjusted returns, and also be doing something good for the world, if you allow me to say that. So yes, there will be future pools, and we will be communicating timelines of the future pools in the coming weeks or month. And what are the advantages of joining the Cauris pool early? I mean, I think I can't really call out any specific advantage, but you want to be part of it. We might have a limitation in terms of how many investors we can let in. So once we actually raise the amount that we are looking for, the pool might get close. So you don't want to procrastinate. You want to pull the trigger as soon as possible to be able to participate in this vehicle.
And I would just add, I think the companies on deck that we've researched and are presenting for immediate funding are very compelling, and I think will be leaders in their space. So I think it's an opportunity to be part of that journey of those fintechs as well.
Absolutely.
Okay. And then another question came in. I think this question is more driven by the bridging that we're all working towards, which is bridging crypto into the real world with regards to tenor. And just the underlying bit here is liquidity, generally is king or queen. And so people generally have a lot of liquidity, be able to get access to capital very quickly. But so the question really is getting to the point, why is it that capital essentially is being locked up, by the definitions used in the crypto space. But why is there a 3-year tenor on this essentially?
Okay, yeah, sure. I can take that. So the 3-year tenor. So I'll answer that in two ways. This pool will be providing monthly liquidity. So basically, we'll be paying income distribution on a monthly basis over the life of a vehicle. So yes, you'll be getting liquidity coming your way on a monthly basis. But the capital that you invested is kind of locked in for 3 years, and the main reason for that is that ultimately you are, as an investor, lending to fintechs that are using the money for their operations. And one big use case for those fintechs, and that's why there's a big opportunity for us and also from the DeFi community, is that they need capital that is flexible, that can actually allow them to basically operate, right? So, and that's why we are really giving fintechs the tenor to basically kind of work out their strategy and actually prove it out and not get the repayment very soon. So that's why 3-year tenors, to basically kind of match with the tenors that the average tenor that we're kind of giving those fintechs. But what might scare a lot of people might be like, okay, what about if in year 2 something goes bad with those fintechs? No, we do have, as we showed you, the deep dive platform that basically makes sure that we can understand exactly how those fintechs are performing, and we can actually go out for repayment anytime that we really feel like we need it. And the fact that we have account control over their cash flows, we can get our money out if there's an event of default before the end of whatever tenure that we've given them. But for us to be able to manage this, the asset and the liability, we need to also make sure that our funding coming through our vehicle also kind of matches that tenor. And that's why we are asking for a 3-year. That's why we are asking for a 3-year lockup, to just make sure that we can allow the fintechs to kind of operate. And while we are also kind of building our business case, we are just trying to also understand what is the biggest pain point for those fintechs. And what we found out that a lot of them actually, and something that didn't really like survive, right, were the one that had like bad mismanagement in terms of their asset and the liabilities, right? So a lot of the traditional lenders will come in and give them a 6-month loan or 3-month loan and asking for repayment, while the fintechs are making loans that are at that tenor, like 3 months. So how can you expect them to not default, right? So that's why a lot of fintechs we can see in the past have been defaulting, because it was really hard for them to mismanage. And we are solving for that. And the structure that we have that kind of provides monthly liquidity should also be useful for any investor wanting to come in with us, to be able to allow those fintechs to actually operate and be able to scale and really reach their full potential.
Okay, perfect. And just being conscious of time, just have one last question, really turns it more so back to us before we wrap. More generally though, is basically why are you raising through the Goldfinch platform or protocol?
Yeah, protocol. Absolutely. I mean, we strongly believe in the future of DeFi. DeFi has a very unique value proposition for financing in going forward, and I'm a strong believer that this is the future, and that's basically how we really want to operate. And I think Goldfinch is offering a platform with a community that is that also believes in that mission, right? And I think for us, it's very important to be able to collaborate with partners that share the vision and that are able to execute on those plans. And we're really glad to be working with Goldfinch and also with other DeFi protocols that are providing that are looking to really provide capital to fintechs across the globe and provide access to to capital to underserved or underbanked customers. So we're really glad to be partnering with Goldfinch. We are really excited to be part of this community.
Perfect. I mean, definitely excited to be partnering with you as well, and hope, obviously hope to see you come back with multiple pools, over the coming months. But with that in mind, just considering the time, just wanted to say thank you everyone again for joining, for sharing your thoughts. And just also want to double tap on the fact that, if there are any open questions that you all have in terms of the community or investors, feel free to drop them in the Telegram group. But aside from that, sign off, say thanks again. And yeah, as a reminder to everyone, as a final point, we'll be opening up the pool tomorrow on Thursday, the 11th of November.
Awesome. Thank you so much.
Thank you, everyone.
And yeah, looking forward to it. Bye.
Thank you.